Yes, hello everyone. Thank you for joining this event, this particular session. We have a great speaker today, and just give me one quick second. Okay, thank you for joining DataCon LA 2021. Welcome to the BI reporting business use case track. My name is Dalakwa Kester, and I'm your host, and our co-host today is Hannah Uda, who will be moderating the chat and question and answer for you during this session. Today we have our guest, Boris Couteaux from ImpakFinance, and he will be talking about identifying opportunities and managing risks with impact on ESG. Boris is a VP Business and Product Development Head at the Data and Scoring Team at Impak, the leading independent impact rating agency. In his prior role with Polonate Energy, a social startup working to improve the lives of India's urban poor by giving them access to affordable products, Boris worked as city co-founder in Kolkata, India. Before that, he worked in various positions in commercial banking and ING Bank in Belgium. Boris holds a master's in business engineering and finance from the Solvay Brussels School of Economics and Management in Belgium. With further ado, I'll hand this over to the speaker. Thanks for being here, Boris.
Thank you, Dalakwa, for the intro, and thanks for the team to having us, the DataCon LA team. Today I wanted to talk about how we help our clients to identify opportunities and manage risks using impact and ESG data. I wanted to feel free to interrupt me with questions. I think this is a fairly small group, so we can have an interactive discussion. So maybe a few words about Impak first. We're a mission-driven company. Our mission is to help investors and lenders make more sustainable decisions by selling them data, in particular impact and ESG data. So we call them impact statements in relationship to financial statements that go beyond ESG, so environmental, social, and governance data, and to include both the negative and positive impacts of their assets. So maybe just a few definitions first before I get into the swing of things. ESG, so as I said, environmental, social, and governance data. ESG data was emerged about 15 years ago and was the first generation of extra financial data the company reported on. A few companies started building ratings on top of this data, and to like credit rating agencies would rate issuers, and the idea was to look at their indicators and build a rating on top of that. Now, a few things where this field has evolved tremendously over the past 15 years, and so we're now seeing more and more demand for impact data. And the difference between both is that impact data looks at ESG data, looks at efforts rather than impact data looking at the results. ESG doesn't really have any common framework that people would use, so there's a lot of discrepancy in the data, and it's also not, the frameworks used are not very transparent. So we're seeing a lot of press and regulation into regulating ESG data, ESG rating agencies, etc. And as I said, more and more demand to go towards impact. And so the difference between another definition, I guess, the difference between positive and negative impacts is the same difference as I'm reducing as a company my CO2 emissions. That's reducing a negative impact that I have. Everyone has a negative impact, but all you can do about that is try to mitigate it, reduce it, versus I make solar panels or renewable energy that I can sell to others and thereby help them reduce their CO2 emissions. So that's the creation of a positive impact there. So with that, I will give you maybe a bigger picture on what the problem is. So today, the financial sector, one of their main challenges is having access to universal, open source, rigorous, and comparable ESG data and reporting. Because, as I said, the frameworks are not consistent, and so not transparent either. So when an investor purchases ESG data from one party or another, they can get very different results, and they're not able to compare them between investors or between a portfolio even. The other challenge is getting quantitative impact data for materiality assessment. So materiality is a process within ESG where you would define, based on different standards, which negative impacts, which issues are significant or material for a particular company. So, for example, a software company CO2 might not be that big of an issue for them, but for an oil and gas company, obviously that will be a big issue. That's material. And the third challenge is we're seeing that more and more in Europe and in the US. The regulators are more increasingly demanding standardized, clear measurements and regulation for ESG data or impact data. So in Europe, there is the EU taxonomy that is a taxonomy of that defines criteria for what's considered a positive impact or transition impact, etc. So there's a whole thing going on there. But in the US as well, the SEC have started to look at regulating that. The other big challenge is because there's no rigorous comparable data, investors find themselves having to work with what they have and often make, because the market and regulators are pushing them, make claims as to, I'll be net zero by 2050 or something, and more and more regulators are coming back to them saying, wait a minute, that's not possible, or that's far from being the truth, or investors say, I have $1 billion in sustainable finance, and those claims are being fact checked now. And so you see investigations popping up all over the world, in Germany, DWS, in Australia, in the States, and with regulators checking those greenwashing claims or alleged greenwashing claims. And so there is a lot of pressure from companies, from investors, to get their facts straight and not over claim what they're actually doing. And so what we provide, what we've come up with, is a human augmented intelligence solution with a 360-degree impact data assessment. So what that means is we use, and start with the middle column, we use a standard that's called the IMP, Impact Management Project, and the 17 UN Sustainable Development Goals, SDGs. It is those two are very recognized international standards that are based on consensus as well, and they're able to provide. We're able to the two frameworks are very holistic in the sense that, again, we look at positive and negative social and environmental data. So a very a broad picture of a company, because it often you need that picture. It often doesn't make sense to only look at it. It's as if you were investing as a finance driven investor and only look at one side of the balance sheet. You wouldn't do that. You would look at assets and liabilities and profit and loss statement, et cetera. So you need a full view of the company. And that's what where ESG stops short of, and that's where we step in. And so we've been able to provide high quality data combining technology and human expertise to better manage risks and opportunities. Because obviously, if a company has negative impacts that they don't mitigate well enough, those can translate into financial risks, such as be it your stock would plummet on the markets, or your revenue would, or you have stranded assets, etc. So there's a lot of ways that will impact your bottom line or your balance sheet. The other important argument that we're making is that as an investor with impact data, you can identify opportunities for investment. So you would companies that answer this huge market that are the SDGs. In the end, it's a very large market. Would obviously be more successful in the long run. And so as an investor, if you are able to identify which companies have a positive impact on certain SDGs, or you would be able to identify them and invest. And the last pillar there on the slide is the fact that we are currently the only solution that is able to do this at scale with private and listed companies using a SaaS platform to deliver the data, and we build, as I said, a score on top of that data. So that's how we view things. A little bit more about the IMP and why it's important is, and I'll make an analogy to the IFRS or general accounting principles, is before them, it was very hard, again, for investors to compare investments and to decide where to invest, because you didn't know if a revenue was you didn't know which accounting rules were used to define the company's revenue, and so they put general accounting principles in place, and so the same thing has happened with Impact, where you've seen, so there's been 2,000 practitioners came together with roundtables for 2-3 years, decided, these are the definitions of 5 dimensions, 15 criteria that one ought to look at to measure or assess impact, and they built this methodology that's universal and evolutive, and a structured network of standard setters with a shared vision to that coordinated themselves to reach this consensus. So it's a very important effort that we're building on. And it's very, as I said, very holistic. And the size of the market is obviously very large. You hear every day a lot of ESG of assets are going into ESG, and there's a high demand for those type of products, sustainable products within consumers, the end consumers, and a lot of financial advisors are receiving questions about that and about further on about what's in those portfolios or those indices, and so there's quite a bit there. So this is what we offer. We have what we call an ISA SDG alignment product with just a high level overview of which SDGs does a company align with positively and negatively, using a materiality analysis, and looking at what percentage of a company's activities, sales, assets, or OPEX are linked with SDGs, because that is a very important number that shows how material that is within the company, and it's a measure of the intentionality of a company. How much are they putting into those efforts? And then that's the first step. It's quite high level. We do that using a taxonomy, linking activities and products and services to SDGs. And then the next step is to go to our impact investing scoring solution with IS Square with Impact Score, which uses the IMP, really looking at contextualizing the data, the indicators. So we collect the indicators, and then we add that human intelligence layer on top of it, where you would contextualize the data. So in Impact, it's very important to context is everything. So one person or company can tell you, I have 1 million beneficiaries. The other company can tell you I have 1,000. But how do you know who these people are? One could be Unilever telling you, for example, I have 1 million beneficiaries, but those are 1 million people they showed an ad about how to wash their hands to. The other company has 1,000, and they could be 1,000 people they lifted out of poverty through different services or products. So those are two very different depths. That's what we call the depth of impact, and those people have different characteristics and vulnerabilities, and so that's the sort of context that you need to be able to bring to impact data, and so that's the type of analysis we do. And then on top of that analysis, we built, as I said previously, a score where you would then be able to use to compare apples to apples, to track evolution, to use as a filter, etc. And then on that score and that data, the third product we're bringing to market is impact indices and ETFs. So based on that data, we're developing a family of impact indices. Indices are very popular means of benchmarking performance for different products, but also using to build investable solutions on. So ETFs, mutual funds, etc. That anyone can invest in, and those are things that we're able to do so that folks would have options to invest in true impact investing, which is on listed equities, which is now possible thanks to the data quality that's increased, and thanks to data providers like us. So yes, we have a few clients. We're a startup. We were pitching on the startup pitch, and we won second place. Thank you, the judges. And we have clients, as you can see, in the US, but mostly in Europe, where regulation is more advanced. Working with asset managers, banks, because as I mentioned before, we do listed and private equity, and all types of basically financial institutions. So this is, for example, what we would do with one client. We built a partnership to build a fund. So we helped the client develop the fund's impact investing strategy. Did a roadshow with the client, provided them with impact statements and an impact score of its investable universe, which they used to select the funds they were actually going to invest, the companies they were actually going to invest in, and then provide them with the data and the platform to do some reporting and benchmarking. So those are the different services that we've done with this fund, and they've launched it a year ago, and it's working quite well. This is a second client case where we work with a bank this time, one of the largest banks worldwide, that wished to become the first European bank to integrate impact data into all of their business decisions. And so after a long due diligence, they chose Impak to standardize that throughout the organization. And so we were starting with one of the departments, the credit departments, that will integrate this data into their credit analysis and decision making. So the relationship manager and the credit and analyst will use that data to bring files to risk management, and risk management will also use that data to make the decision. And so we've developed also for them specific data subsets that they were interested in. And it's completely integrated through APIs into their workflow and software, so that within their backend, when the analyst does the credit pack to be sent to risk management, our data is there and ready to use for the analysts. So that's another example of how we help clients, and so identify risk, but also, as I said, opportunities. So this particular client is using our data to identify which companies they could help providing them with sustainability linked loans or other impact products, financing products. So those are quite popular right now. And will continue probably, and that's what this client is doing with the data. And there's a lot of other uses of the data, obviously, that they're able to do, but we're just starting the relationship, and so that's where we're at. Well, there you go. I went a little faster than I thought. Maybe I realized I didn't have any information on Impak as a company. So we're a small but mighty team based in Montreal, Canada. It's where we just hired a bunch of people, so we're now 50, and hiring some more to meet the demand. We are hiring mostly impact analysts and people within our tech team. So if you're interested, feel free to come talk to me about that. Or if you have any questions, generally happy to, this is my email address, happy to answer any questions right now or later as well.
All right, any questions? Let's see. We could wait a few minutes here, but I think after a few minutes, if there are none, we could give some time back to the attendees.
Sounds good.
Okay, we'll wait for Dolapo.
Thank you, Boris. It's very insightful, very informative topic on identifying opportunities and managing risk when it regards to ESGs.
Thank you.
I wanted to just kind of, it's I know it's a new area, and I know the environmental consciousness of trying to make sure the environment is making it environmentally friendly, cautious decisions within companies. Like you mentioned, Unilever, how they're doing whatever they, contributions that they're making impacts to with the products or they stand for, and how they're helping the world, making an impact on it, making a difference. I wanted to ask a question on, I know this is kind of a broad, for example, Netflix. We are consumers. We watch a lot of shows and we stream quite a bit. And there was this talk about a lot of, this content we receive is through the cloud, and there's servers, and they consume so much, and there's a lot of power that is, generating those power. It's causes a lot of power energy emissions. How would you be able to approach those types of areas of industry compared to Unilever?
Yeah, so it's through the materiality analysis. So we use different standards to define, whether or not different issues are material, as I said. And so in this case, I'm not an analyst, but I'm pretty sure CO2 emissions would be material, because, as you said, they are one of the they're substantial. I don't know if for Netflix, if I'm sure they do have a large CO2 consumption, but also their consumers do. So it sort of depends where their consumers live and how their consumers, which kind of energy their consumers produce. But on their data centers, obviously what we're going to look for is how they're powered. And so there's very, most of Google's or Amazon's data center, certain centers are using renewable energy. I don't know about Netflix, but there's a lot of solutions out there for that, and so we would look for that. But that's a negative impact they could mitigate, right? So which is the basis, because what the theory is that in order to be able to market yourself as, I'm creating a positive impact, well, first you have to clean up your act. You have to mitigate your negative impacts as much as possible, because, again, to give an exaggerated example, you don't want a renewable energy producer to say, hey, I'm making these great solar panels, but I'm using kids in wherever to make them. And so that's what you don't want to do. And so that's called a do no significant harm principle, and that's included into some regulations in Europe, particularly. But it's so we're always going to look for that from companies before we can look for or positive impacts. And for Netflix, again, I don't know. But I'm sure they will try to tell you, we have these great positive impacts. But what you need to look at is, how are they mitigating their negative impacts? Because, again, everyone has negative impacts. It's about what you do to reduce them as much as you can, and then you can look at how to create positive impact and value. Does that make sense?
Oh, you're on mute, Delapo. You're on mute.
Delapo,
Yeah, I'm back now. I was clicking on it and it wouldn't budge. But thank you for that response, and it does make sense. Well, and I think going back to what you just said about the contextual data, like many of the things that the stories or the approach of how they make those positive impact, of what examples and how it is relatable. You are you able to on the full scale of it? I mean, if I say, for example, I'm investing $1 million to, um, you know, to construct renewable energy source, if it's solar, if whatever means to help cut down on emissions of normal conventional power source, which is one area. There's a couple of things that might come into play, but I mean, those information, are those divulged to you? How do you capture those types of data?
Yeah.
You
No, that's a good question. We have different ways to collect data. We use technology in a variety of ways, using, but most so there's basically two ways. For companies that disclose, we use their disclosure and scrape them and use AI and machine learning to collect that data and to structure it. So that's easy-ish, because NLP is what it is, and we can't do everything, but we can do fairly. We can be quite good there. For companies that don't disclose, mostly unlisted smaller companies, we have an online intelligent questionnaire that we can send them to collect the data, and then we have to verify what they're saying, et cetera, et cetera. But the power of it is that the questionnaire is structured to the IMP, and so obviously fills into our data model right away, and we're able to produce the same analysis for both types of companies. And we also use obviously news and NGO reports and etc. to fact check and to feed into the model, and we compare data from issuers from the same sector to verify, to sort of check, because the truth of the matter is that there's a lot of exaggeration, and companies are always trying to place themselves in the best light. So we always have to try to be conscious of that as a rating agency, and make sure claims are verified and if possible audited. And so there's a within the score, there's a factor on the evidence risk. How good is the evidence on the claims from the company, and obviously if there's no evidence, we'll take it into account, but it'll be discounted. Whereas if there's a full audit done on extra financial data, which happens more and more, then we have more confidence that that data is correct. So that's a few different things we do about data collection, which is a key aspect of our business. And but then, because then we add intelligence on that data and then sell it to investors. So yeah.
Well, thank you so much. Thank you for the attendees. It's great to have everyone here, and it's a great topic today, and
thank you.
A pleasure to have you at DataCon LA 2021. If anyone has more questions, I think we have a few minutes to see if there's any. And if there is, we have a survey for anyone, the attendees, to just tell us how this topic, or the speech, the topic today of talk went. And if you have some information from Boris, if you have further questions or comments.
Yeah, feel free to contact me, as I said.
thank you so much. And thank you for the attendees. Thank you, Boris.
Yeah, thanks everyone.
Yeah, enjoy the rest of the weekend.
You too. Yeah, it's I'm in Canada, so it's
late. I know.
7:30 p.m. Right now. So yeah.
Well, are you on the, like you mentioned, Montreal, so the French-speaking province?
Yeah, I'm originally from Belgium, as you might have guessed as well from the intro. So, and maybe from my accent, although I try to hide it. So yeah, it was sort of a logical choice. But I'm actually based a little further from Montreal, but yeah, I have 2 small kids now, so it's time to put them to bed.
Oh, great. I'm sorry to, let that happen. And
Yeah.
thank you so much for making time for us.
No worries. Thank you for having me, and have a good, good of the weekend, everyone. Bye-bye.
Yeah, have a good evening.